name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is How to Value Your Accounting Practice. Before we begin, we need to cover a few important items. First, please close all other programs running on your computer. This will help to ensure a quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. First, you must participate in all 3 of the polling questions that we'll ask throughout the presentation. Please note that GoToWebinar does monitor your participation in the polls. Next, you must complete an online evaluation in order for your CPA certificate to be sent to you. If you register directly with Transition Advisors, I will email you a link later this afternoon. If you registered through CPA Academy, your evaluation will be completed through them. For everyone on the webinar today, there will be a very brief survey that pops up after the session ends. This isn't the one required by NASBA, but it does provide us with information to make sure that we present the webinars that you're most interested in. And it also gives you an opportunity to request further information, such as articles or a copy of today's slides. In order for you to fully participate in the webinar, take just a moment to familiarize yourself with the GoToWebinar control panel on the right-hand side of the screen. The orange arrow near the top of it will minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box at the bottom of the panel. Just type your question in the box and click Send. Questions are important to us, and our presenter today will answer those at the end of the presentation. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include a 2014 Marketplace Update, a session on partnership agreements, and one called 7 Steps to Making Your Merger or Acquisition Occur. You can see the dates there on the screen, and you can also go to our website to see other dates and to register for all of these free webinars. As a reminder, before we get to this first poll, I did send a link to everyone in the reminder email with a link to the slides for you to download. I've also just sent it out via the chat function, so if you'd like to follow along, you can click there. That said, we would like to go ahead and launch the first poll for today. So take just a moment to select your answer. The question is, how many partners are in your firm? So the options there, 1 to 2, 3 to 8, 9 to 20, or 21 or more. And it looks like nearly everyone's voted. We'll give just about 10 more seconds for everyone to indicate their answer here. And I'll go ahead and close the poll. You can see the results there. 81% indicated 1 to 2, 15% 3 to 8, 3% 9 to 20, and 2% 21 and above. So with that said, I'm going to go ahead and turn it over to our presenter today. Joel Sinkin is the President of Transition Advisors. Thank you very much, and I hope you enjoyed today's webinar.
Okay, Nikki, I'm looking for that show my screen.
Let's see here. Did you get the button now, Joel?
I have not. That's a first for us.
Let me try sending it just one more time. I'm going to make myself
There we go. Okay.
Did you get it? Okay.
I did. Sorry for the slight delay, and everybody, welcome. Welcome back to Elm Street. I remain Freddie, and today we can you see my screen, Nikki?
No, Joel, I'm showing the. There we go. Now I can. We're all
right. Again, my apologies, everybody. Today, I teach a voluminous amount of CPE, but this is always my favorite topic, how to value an accounting firm. Because the overwhelming majority of the people on the line today, based on firm size, are focused predominantly on how to value a practice for an external sale, the lion's share of our dialogue will be about that. We certainly will also discuss how to buy out partners and how larger firm deals work as well. But one of the reasons this is my favorite session is everybody comes to this with 3 main questions. The first one's, what is the multiple? The second one is, what is the multiple? And the third one's, what's the multiple? And I promise today we're going to talk about that. but let's move down that path. I don't like to turn these things into infomercials, but I do think it's important to have an idea of the background of the speaker. I'm the president of Transition Advisors. The only thing I've done for the last 25 years is help accounting firms buy, sell, merge with each other, dealing with succession issues, growth issues, internal succession readiness, partnership agreements, everything very, very specific. And really what we're talking about with everybody is not so much everything we've learned because of how smart we are, but all the lessons we learned by watching mistakes and making mistakes. And because we've made so many of them, and we try not to make the same mistake twice, kind of the dumber you are the first 15 years, the smarter you are the next 10. And this is just some of our different teammates that help us run the company all over the country and in Canada. Whenever we're talking about valuing a firm, enough with the propaganda, I always say if there's 50 things you need to know about completing a transaction, the smartest person in the room is going to think of 35. And we're not going to get you to 50 today. And the reason we're not is it's incredibly how unique all these types of deals are. Did we just lose everybody again? So hopefully, never usually have these technical issues. I'm really sorry, everybody. I'm probably the cause of it. But at any rate, what happens is, if you took 2 practices or 10 practices doing $500,000, $1 million, $4 million with the same amount of partners, there may be nothing else the same about them. So the uniqueness of each practice really helps really identify how things can vary and how different things can be at all different times. There isn't an article today that doesn't talk about a magazine that comes out, at least, that doesn't have an article about buying, selling, merging accounting firms in our profession. So let's understand why the activity is so high as we come to this great topic. First of all, if you think back historically, 2006, 7, and 8, most accounting firms were growing organically at such an incredible pace that M&A was kind of different then, because the big problem everybody had was staffing. The work was there to get out for most firms. The problem was getting people to get it out. Then 2009, 10, and 11, and the economy turned, and I heard more problems about accounts receivable than I did about growth. So in 2006, 7, and 8, the main focus of M&A was to add niches and add talent. 2011, 12, and 9, 10, 11, and somewhat 12 was really more about bottom line revenues adding. Kind of here we are in 2014, and we're kind of facing a little bit of both. So what are the driving factors in acquiring and forcing firm valuations to be looked at differently now? Well, first of all, niche development has a lot to do with the M&A marketplace. A lot of times, for example, there may be a firm that does a lot of wealth management, and a firm that has a lot of high net worth individuals may target that firm. Well, I may deal with a tremendous amount of law firms, and your firm does litigation support and business valuations. So those types of things tend to push people into certain types of M&A activity for niches. But by far and away, the most overwhelming factor that's impacting M&A today are the baby boomers. There are some incredible statistics out there, some of which we'll share with you, about this aging of the community. How by the end of today's 1-hour session, over 30,000 people in this country will turn 65. Almost 2/3 of accounting firms, according to the succession survey of 2012, have suggested that succession will be a significant issue in their firm. So how do we go about handling all these baby boomers? And what really mitigates the issue is traditionally it's the people that have been in the profession for 15 to 25 years that become the next tier of partners. But when you think about it, 15 and 20 years ago, we were having the lowest amount of college graduates graduating in accounting and the lowest percentage of them sitting for their CPA exam. .coms and a lot of other things were taking our best of our best away. Fortunately, the worm has turned. But here we are at the lowest percentage of people ready to step into that partner role at a time we're having the greatest exodus we've ever had in the profession. So let's start with, is it a buyer or seller's marketplace? A really fascinating conversation because you could ask a lot of people and get a lot of different answers. But there really has to be viewed in a slightly different way. So, for example, if I'm a small firm, let's say under $2 million in many places, some places a small firm might even be under $1 million, depending on the density of population in your area. But if I'm a small firm, and let's say I'm in Nassau County, Long Island. I know my accent, you all probably thought I was from Atlanta, but I'm actually from New York. And in Nassau County, I pick it purposely because it has the most accounting firms per square mile in any place in the country, 3,100 accounting firms in a relatively small county. So if I have a $500,000 practice and I'm looking to sell it in Nassau County, it's a huge seller's marketplace because in that area there are an extensive amount of firms that could absorb my practice into their infrastructure with no incremental increases in overhead. Therefore, it's an amazingly profitable acquisition. If I'm 30 miles outside of Boise, Idaho, I might be in some of the most beautiful country we have, but there may be one accounting firm for every couple of zip codes. In that case, it's a buyer's marketplace. I've actually consulted on firms in very remote areas, and the firm said to me, I will never buy that person's practice when they retire, because when they retire, the clients have no place else to go but me. So that's where supply and demand takes over. What's really now, if I'm a $15 million firm and I'm looking to go up, there's nobody that can absorb me without substantial incremental increases in overhead. So that's where the market is really taking a huge change, because as you increase in revenue, the pool of potential successor firms shrink. So, for example, right now, I would say to you, for the first time in the 25 years I've been doing this, it's always been a heavy seller's marketplace, other than these real remote areas. Right now, a firm that's in trouble, for example, are the $3 to $8 million firms. You might see that we write a lot of articles for the Journal of Accountancy and other places. I'm working on a case study right now for Accounting Today, where basically we looked at Boston as a sample marketplace. Everybody thinks it's a giant city. It's really not. But so it's kind of like a decent-sized city that gives you a good indication. So far, we've discovered 44 firms in the greater metropolitan area of Boston doing $3 to $8 million in revenue. But we've only identified 4 firms that are independents that are large enough to be their successors. So here is a very different marketplace. Here's a situation where of those 44 firms, I'll bet you most of them think they have the talent on the bench to execute an internal succession plan, but the majority of them don't. So when they are all forced into suddenly looking to go in, find an external solution, it's become and already has been very much a buyer's marketplace. If I'm a $30 million firm in the Boston area, I really have lots of choices. And to give you an example of that, I recently had a national firm that's not in Boston that wanted to be approach us and ask us about getting access to Boston. And they said that they needed a firm at least $5 million to start. But here's what they said that was amazing to me. They said, let's say you had 2 firms doing $6 million. One firm, the metrics are kind of weak, but they are paperless, they're on the cloud, they have portals, they're multi-screens. The other one is $6 million, has much better metrics, but they still have the paper, they still have one screen, etc. He said, I'll take the one with the better technology. I was shocked. I said to him, because I figured I'm cheap, maybe he is that because it's going to cost you about $10,000 a head to get them up to your level of technology? He said, absolutely not. He said, the problem is it took us 8 years to throw out the paper, to get everybody to make these cultural changes. To take a step backwards in culture, I don't want to do. I can help them with their metrics. I can't help them throw out the paper. A couple of years ago, you'd never hear something like that, not just because IT has created its own culture, but because you wouldn't be that particular. Now you can be particular. So as you grow in revenue, your market shrinks. Smaller firms tend to get higher valuations than buyer firms as well. Let's remember, a smaller firm, not only could it be absorbed with less increases, but small firms frequently can net 40 to 60%. A big firm's lucky to net 33, 35%. So we're working with different numbers in these situations. What helps the marketplace keep it fresh, though, is at the end of the day, an accounting firm really only has 3 methods of growing. One is clients at a time. In a good economy, that's wonderful. In a challenging economy, it may only keep you up with natural attrition. The other way to grow is a marketable niche. Again, business valuation, lit support, international tax, we can go on and on. But the fastest way to grow remains merging or acquiring another firm. So again, a small firm in a densely populated part of the country, very, very strong seller's marketplace. Sparsely populated areas, large firms, closer to, if not a buyer's marketplace. So before we could talk about how to value an accounting firm, we need to look at structure. I assure you we'd go right to multiple after this. But the deal structure heavily impacts aspects of the valuation. So what I've put on your screen are 5 main different methods of structuring deals that we'll see. And later you'll see how these tie in to how a lot of large firm deals get done. So the first one on our hit parade is called a straight sale. A straight sale, I'm not necessarily referring to a seller selling their practice and going to Boca Raton the next day. What I'm referring to is, as a seller, I'm no longer looking to stay on in a full-time role. I'm not looking for equity. Therefore, I'm looking to sell my practice, probably looking to stay on in a reduced role, hopefully to do a proper transition as well, but that's what we're going to call a straight sale. It's probably the minority of deals I'm involved in, but obviously a deal that's done frequently in the country. The least often deal that I see is a buy-in to a buyout. Let me use simple numbers. Let's say that my firm's $800,000 and Nikki's firm's $200,000. Well, the new firm's $1 million. In order for Nikki to have been an equal partner, she needed $500,000 in revenue, but she only came in with $200,000. So she initially acquires $300,000 of my book with a multiple and payout period, etc. And then maybe 5 years later, I'll retire and she buys out the balance. A buy-in to a buy-out. Right? Sometimes that's done where I won't even, as the firm looking for succession, I might have the firm just buy into mine and not want to be any part of their pre-existing business. But most of the time, we throw the whole thing together. A merger to a buyout is very similar to a buy-in to a buyout, except there's not an initial acquisition. This tends to get done more often than a buy-in to a buyout. So in the example I just gave, where Nikki had $200,000 and I had $800,000, when we merge, she's probably going to be a 20% equity partner, and when I retire, she buys out my 80%. A buy-in to a buyout. One of the deal structures that's happening more and more frequently out there is a cull-out sale, where we're taking a portion of the practice and carving it out and selling it. There are a couple of different examples that you see on a fairly often basis these days that come from a cull-out sale. For example, it might be that I'm culling out a niche to sell or keep. Here's a great example. Last year in our Washington, D.C. office, we had a firm doing about $1.5 million of traditional accounting and tax compliance work. They also had a wealth management division. The owner of the practice loved the wealth management, hated the deadline-driven aspects of the traditional accounting firm. But what happened was he always kept the accounting firm because that was his springboard to the wealth management until he actually read a book that we wrote that talked about this scenario. I guess we're supposed to talk about the AICPA book, but they'll get past us if we don't. At any rate, here's how the deal ended up working. We introduced this practitioner to some firms that were larger than him, that dealt with high net worth individuals, but were not doing wealth management. He ended up doing a deal with one of these firms wherein he signed a non-compete as it related to traditional accounting and tax work. The acquirer of that signed a non-compete as it related to wealth management. They moved into together. They sent out an announcement letter that basically said, from the gentleman who was selling the compliance portion of his practice, the accounting and tax compliance, and basically said in the letter, it's impossible to stay on top of the day-to-day changes in the stock market and the ever-changing business climate and tax laws. So John Doe has merged with Jim and Paula, And Jim and Paula are going to help focus on the traditional accounting and tax needs, while John focuses on the wealth management. So they held it out as a merger of specialties. They even created a new business incentive program where future referrals, because every new wealth management client needed an accountant, and all of their clients might need wealth management, and since they were licensed, they were able to share legally the fee. So this is an example of a co-out sale where we kept a niche and sold the rest. You've all seen recently in the last year or two some large firms that did the opposite, sold off their business valuation departments and things. So that's one type of co-out sale. Another type of co-out sale is a great example is somebody that we did in Florida last year. I believe it was Florida. It was approximately an $800,000 practice, so a relatively small firm. He had about 150,000 of his favorite clients. They weren't necessarily his best paying clients. They were clients he's known for years and just really enjoyed working with them. So he sold the $650,000 of his revenue to a successor firm, signed a non-compete, but was able to retain what I wrote in the contract as Exhibit B clients, the 150 that he wanted to keep. So he signed a non-compete that he wasn't going to work on anything but those clients. He retained those clients, and because his overhead was practically nothing, his gross was practically his net on the 150 he kept. Add that to the purchase price, he almost made the same money selling the practice as owning it, which is quite rare. And he gave the buyer of his 650 the first right of refusal to take over the other 150, which he figured would probably be about 5 years later. So another type of call-out sale. It's like a stepping stone to complete succession, but retaining something to stay, quote-unquote, busy. A newer type of call-out is something that I'm running into now. We do a lot of internal succession readiness assessments for firms, and unfortunately, most of the time we come to the conclusion that a firm doesn't have the talent on the bench currently to execute a succession plan. It's not a financial issue that how can we afford to retire all these buyers. As we'll talk about shortly, if the deal's structured correctly and the value's correctly, it's cash flow positive. The problem is capacity. If I'm a 7-partner firm and 3 want to slow down in the next 6 years, that's a lot of partners to replace. So most firms are always looking for the highest commodity in all of public accounting today. Young talent with a book of business, or heck, just young talent. But it's so hard to get, so incredibly difficult, and so large firms are paying so much money to young partner level talents to get them in. If your succession plan is that I'm going to get young talent to bring in, it's a pipe dream at this point in time, much more likely than a succession plan. So there's a great example was a firm on the West Coast that we worked with that after 3 years of trying very hard to find young talent and being unsuccessful and making a defined decision that they were not going to merge into a larger firm. Personally, I didn't agree with them, but I understood their reason. Out of desperation, we came up with a carve-out sale. $1 million of their $8 million was their lowest paying clients. A lot of people say, well, fire them. You're not going to fire them. Who are your lowest paying clients? Clients you've had the longest, because you wouldn't have taken them on at that rate at this point in time. Most of us are pretty loyal to those old clients. But $1 million of that $8 million took up over 30% of the time and effort and resources of that firm. So we found a smaller firm who, and in that case, our basement clients was that firm's ceiling. And we created an affiliation. And we said to all of our $1 million clients, we said, look, because of our peer review requirements of reviewing things and doing certain things, we're going to have to dramatically raise your fee. So instead, we've created an affiliation with John and Jane Doe. They're going to be able to provide you the same services with the same fee structure, and we'll be of counsel to the firm. And this way we can continue to keep you getting service professionally under the same fee structure. By selling that $1 million, the 20% for 5 years that they happened to get for that practice was more money than they were making, but it also created enough capacity to execute the succession plan. Because they had enough to replace 2 of the 3, they just didn't have enough to replace all 3, and now they didn't need to. But by far and away, the most often deal that we see is a 2-stage deal. I used to go around the country talking to small firms and saying, why do you have your clients? You see, most of our clients have no idea if we're competent or incompetent, because if they knew that much to measure our technical skills, they'd be doing the work themselves and not paying us, unless there's a test involved, obviously. But the point is, most of our clients have no yardstick to determine that. And so why do you have your clients? It's because of you. They're comfortable with you. If they love your fees, raise them. They should live with your fees. But they're comfortable with you. So a partner loyal practice, as opposed to a brand loyal practice, takes much more time to transition. And what mitigates this even greater is the fact that when I first started in 1990, most small accounting firms went out every month or quarter to see their clients. Heck, a lot of them did the work there, wrote their check, the client signed it and left. Welcome to 2014. We communicate with our clients more than we ever have. Cloud, portals, email, phone, staff going out. But 87% of partners of accounting firms are only with their clients once a year. So when someone says to me, I'm 3 years from slowing down, it sounds like an eternity. It's only 3 visits. So we need to start the transition earlier for partner loyal clients. So I went around preaching this, and everybody agreed with me. Everybody said how smart I was, and nobody did the deal. Now, what should have taken me weeks or months to figure out took 10 years later. And 10 years later, I realized what the answer was. The answer was accountability. When you're master of your own domain, if the work has to be done on Sunday, you do it. If it's Tuesday and you think you can get out, you leave. But the idea of having the accountability of merging with another firm before I'm ready to retire was so distasteful that people procrastinated and didn't do it. So we needed to come up with a structure that enabled you to remain independent, autonomy, control, income, but put together a succession plan. That's what a 2-stage deal does. So let's walk through a 2-stage deal, and then we'll kind of put this together like on the wax on, wax off. Stage 1 of a 2-stage deal. The first thing we do is we say to the seller, how much is your net? When I say net, I'm talking about perks, benefits, the kid's cell phone, whatever they're running through. So for this discussion only, let's use a small firm. We'll tie it into big firms shortly. Let's say it's the owners of a $500,000 practice, and including perks, benefits, and everything they're making, let's make it profitable, 40%. The next thing we have to calculate is what labor do I use if I'm that $500,000 practitioner to make that money, not including my own. So let's say that we determine that I have a full-time senior that works 2,200 hours a year, a full-time clerical para that works 2,200 hours a year, and a per diem during tax season for 500. So now we know how much labor I need in addition to my own to service that $500,000 and make that 40%. Now in a large firm, instead of worrying about how much labor each owner uses, we would probably focus more on the owner's chargeable time. In a small firm, we won't. The next question we'd have to say is, okay, how many more years does Joel want to work full-time? So let's say that I might want to work 10 more years part-time, but only 3 years full-time. So now we've established the criterion for a 2-stage, for stage 1. I have a $500,000 practice. I net 40%. I have 2,700 hours between per diem and my regular senior level accounting and 2,200 hours of clerical. Stage 1, the successor firm says, Joel, you come on in and move in with me. And we're going to take over all your operating costs, labor, rent, everything. And since in the past you were making 40% of what comes in, we'll continue to pay you to your entity as a consultant 40% of what comes in. Now, by paying it to the entity, not only does that give my successor firm a current deduction, but part of the advantages I had in owning a firm was running certain expenses through my entity. I could continue to do that without having to get anybody else's permission. The successor firm says to me, Joel, I'm not worried about how much time and effort you put in because I don't pay you for your time. I'm paying you your 40%. It's all figured in. What I'm worried about is how much time and resources I have to give you. So I'll pay you 40% of what comes in. I'll provide you 2,700 hours of senior level time, 2,200 hours of clerical time. Whether it's the same people or not, we'll see. So now, continuing on in stage 1, let's talk about what happens for the seller. Now, before I do that, let me explain there's only 2 ways that as a seller, I'm going to make less money in this situation. The first way is if my fees go down, because I'm getting paid 40% of what comes in. But there's a great silver lining in that. Let's say in my $500,000 practice, I had one client that paid me $50,000 a year. If I lost that client and didn't do this deal, I'd lose $50,000 of personal income. My labor, my rent, my software, malpractice, everything's the same. But in this deal, I only lose 40% because they're paying me on a percentage. So it mitigates my loss. The other way I could make less money is if I suddenly needed more labor than I used in the past. Well, most likely the only reason I'd need more labor is if I decided to work less. But if I did need more labor, what would I have to do? I have to pay for it. So in a two-stage deal, if the seller in stage one needs more labor than they used in the past, there's a charge back to them. For example, it might be 67% of the normal billing rate of whatever excess labor you use based on the old one-third labor, one-third overhead process. So from a seller's perspective, I get to merge into my successor firm. Most likely I get to work a little bit less because they're going to take over the administration, billings, collections, IT staff. I'm going to use that extra time maybe to play some more golf, maybe to develop more business, maybe to do the transition, hopefully a little bit of all. So I get to come and go as I see fit. I'm not a clock-punching employee. I have this wonderful backup and support. I am probably be able to offer more services to my client base and grow them because of the bigger platform my successor gives me. I'm doing a great transition. And in a way, it's kind of like a PCA agreement, a practice continuation agreement on steroids, because if I get hit by the bus, there's an automatic acceleration of my purchase price. So that's the great advantages to the seller in stage one, autonomy, control, and income. So why would the buyer do it? Well, let's look at that example once again. And if I'm probably paying, let's say, $50,000 a year in rent, let's say that they're going to move me in, they're going to save that. They're going to save the $10,000 in software I paid. They're not going to need my clerical, and they may not even need my per diem based on their excess capacity. They'll probably keep my senior. So they might put as much as $100,000 or more of overhead synergies in their pocket during stage one, housing the practice. Now, I remember not too long ago in our Chicago office, we were doing one of these deals, and the seller called me up 2 weeks before closing and said, you know what, they're going to save $210,000 in overhead synergies. I should get some of that. And I screamed at him, of course you shouldn't. He got everything he wanted. Backup support, control, succession. The fact they were making some money is why they did the deal. Don't take away their rationale for doing it. I mean, they're taking on a lot of responsibilities. They're taking on all the liability and exposure. They have to do all the integration and all these things. It's got to win for both. So here, in a two-stage deal, the seller's kept whole, has a succession plan, buyer's making some synergies, they're doing a great transition so that they can retain the clients. Stage two begins when stage one ends, which usually is the following. In the example I suggested, I said 3 years full-time. So in the contract, it would probably say that stage one will terminate and stage two will commence on the first of the following events. The end of the third year, God forbid, death or disability, or we simply mutually agree. So stage one terminates and stage two begins. That's when the buyout starts. See, I can't keep you whole in income and pay you for your equity at the same time. So by deferring one for the other, I'm able to get paid maximum value for my time and maximum value for the practice. So that brings us to what's the multiple. But let's do our second polling question so we can get that taken care of and make sure you get your CPE. Then we'll answer those questions. Nikki?
Okay, great. The second poll is on your screen now. This question has to do with your organic growth over the past year. You can see the options are same as last year, grew less than 5%, grew greater than 5%, or less than the prior year. We'll give everyone just a few seconds to complete the poll. Looks like nearly everyone's done. Just about 5 more seconds and I'll close it. This is our second poll of the day, and do keep in mind that you need to complete all 3 in order to get the CPE credit.
If you're going to be stuck listening to this New York nasally sound, get your CPE, everybody.
All right, Jill, I've gone ahead and closed that. The results are on the screen now. It looks like about 38% of the folks on the call grew greater than 5%. Another quarter or so grew less than 5%, about another quarter same as last year, with the remaining 9% saying less than the previous year.
Well, pretty close to what the AICPA's recent surveys have said. You know, we're doing better than we did in 2009, where we were actually suffering some attrition in 2010, but we're not knocking down the doors. I'll tell you that the larger firms are doing better than the smaller firms. Conversely, in 2009 and 10, the larger firms took bigger hits than the smaller firms. So let's get to that age-old question, what is the multiple when selling an external practice? All right. Now, when selling an external practice, what I'm just going to try and teach everybody is that the multiple is the effect. Let's focus on the cause. If you were one of the 8 people in 1990-something bought the first book I wrote, I talked about 9 variables that make up purchase price. Don't hate me, there's really 5. I got paid by the page. So let's look at the 5 main variables. The first one is cash up front, if any. Now, I know that there's a lot of people out there talking about getting paid cash for their practice. Over 800 closings of accounting firms, over 24 years, almost 25 years I've done this. I've never been involved with one. I hear about them, but they're very rare. So most of the time, what we're looking at, from my perspective, is an average of between 0 and 20% as a down payment. And to give you an idea about that, I have more at 0 than I have at 20%. If there was a typical, I'd say 10% up front. But money up front really depends on much more than just the depth of my pocketbook. And this is something that's important to understand. Let's look at a couple of the reasons. Let's say I had $1 million practice, and by May 1st, I billed out $750,000, $800,000, and you're taking over July 1st. I've already sucked all the profit out for the year. You might be operating that practice at almost a cash flow, even a loss. It's very hard to ask for a big down payment if I just finished sweeping in all the revenues. Treatment of accounts receivable could be a great example. We had a deal in our Philadelphia office last year, or the year before, I guess it was, where the seller was a good person and very friendly with the clients, but was very lax in their collections of the accounts receivable. So there was a voluminous amount of clients that were 90 and 180 days late in payments. The seller was saying, hey, the first dollars that come in should go to me. Well, that's your down payment. It's hard to ask me to work for more than 3-4 months before I start participating in the cash flow and give you a down payment. Matter of fact, in his case, anybody that took more than 90 days to pay, we actually ended up using that money and having a payout period on that too, or it just became too challenging to do. You know, the bottom line is we look at it as a business person. If I'm giving you a certain amount of money up front, how long will it take me to get a return on that investment? And between challenges in accounts receivable today, tightening of the loaning market and things like that, we're just not seeing big cash up front. Matter of fact, generally speaking, and quite specifically actually speaking, values of accounting firms in 2013 and 14 have been much less than they were when I first started. When I first started, we saw a lot of multiples, 1.5, even 2 times. We're not seeing things like that right now. It doesn't mean the seller doesn't have a marketplace. We already discussed is it a buyer or seller's marketplace. But the tens of valuations have come down. Second variable is the duration of the retention period. This refers to the time, how long after closing, if a client is lost, does it impact the purchase price? 80% of the deals I'm involved in are a collection deal, an earn-out deal. So if I'm getting paid 1.2 times over 6 years, someone's paying me 20% of collections for 6 years. Some of the deals we're involved in have a shorter retention period, 1, 2, 3-year retention period. What's kind of counterintuitive is what works best for the buyer and what works best for the seller. Again, in an article I'm putting together as a case study for the Journal of Accountancy, we looked at that, at almost 100 deals. The worst deal for the seller, at the end of the day, turned out to be the 1-year guarantee deal, where they were looking to lock the purchase price as early in the game as possible to mitigate their risk. But what happened was buyers reduced the value much greater because of the greater increase in the risk situation. So buyers ended up offering a lower multiple. They were much more aggressive in instituting their changes. They didn't want to lose a client in month 15. They could have lost in month 5. So they kind of shook the tree real hard and made sure loose leaves fell off. So at the end of the first year, the seller locked the purchase price at a low point in time of revenue with a lower multiple by a least patient buyer. A 2-year guarantee in most situations for small firms seems to work actually better for the buyer than the seller. The theory behind that is if I did an immediate sale with you and Gretchen bought my practice right now and she serviced the clients in 2015, if they come back in 2016, they're hers. See, the second year is the greatest measure of success of a transition because they went through the change, saw the change, and elected to come back. So locking it at the end of the second year tends to stop the seller from participating in the fee increases going forward. Now, the exception to that is really large clients. I met with a firm in the city yesterday. They're a small firm doing $1.2 million. Between their 2 biggest clients generate $400,000. Those 2 clients would have to stay on retention to most buyers for the whole payout period, but they might consider locking it earlier for the rest of the clients. But what worked out the best for the seller, as counterintuitive as it is, was the collection deal. By removing much of the risk, buyers were prepared to offer a higher premium. They were more patient in the transition. And how many clients would I have had to lose to get back to what that lower multiple would have been with a shorter retention period? Also, most of the collection deals I'm involved in, the seller participates in the fee increases. I think it's really hard to say to a seller, I'm going to pay you less if the clients pay me less, but if a client doubles its fee, you're not going to get that either. A good deal is a fair deal. If they're going to participate on the downside, they should participate in the upside. So if the 5 variables of valuing the practice, the first one's cash up front, if any. The second one is the duration of the retention period. It says an economy clause. An economy clause sometimes fits in where, let's say I only had a 2-year retention period. If in year 3 I lose a client to another local accountant, shame on me. But if I lose them to the economy, they went out of business, sold, something to that degree, you'd have lost them too. And sometimes we'll see an adjustment made for that. The third variable of the 5 is profitability. But this is always confusing to people because as accountants, we're trained to look at a business, say, here's what the profit is, therefore here's the value. Yet I'm going to tell everybody I don't care what the profitability is of the seller when valuing a practice very often. But let's understand why. Coincidentally, I had this conversation with a potential consulting client today in Pennsylvania. And the example I gave them was, let's say 5 years ago I had a $300,000 practice. I operated out of my home. My wife, Kathy, answered the phone. My net was what, 85, 90%? Then we were tired of people knocking on the door, so I took an office. When I took that office, Kathy didn't want to come with me, so I hired an office manager. I also decided to play golf once a week, so I hired a per diem. Now I'm netting 40%. At which point in time was my practice worth more to you as a buyer? It's irrelevant. The profitability that I refer to is the profitability of the deal. If you could absorb me into your infrastructure with no incremental increases in overhead and had the capacity to take on the work, then it's an amazingly profitable acquisition. If I say you have to keep my office manager, you have to keep my location. If I say I want to get paid in goodwill, and you have to deduct it over 15 instead of the payout period, those things do what? They reduce profit. So when I speak to profit, I'm talking about the profit of the deal. And turn this into an understanding of how you have to transpose everything you see into what your firm will be. A great example of that's billing rates. You know, we had a firm in New York a couple of years back it was a very unusual firm in the following. It's only $1 million. It was owned by 2 partners who had no seniors, no juniors, just a bunch of clerical, paraprofessionals, bookkeepers, and the 2 owners. They did all the heavy lifting. Lord knows they each put in over 1,800 chargeable hours. We were closing in on a deal with them at one point in time when one of my clients said, you know, Joel, I just realized we got a problem. He said, you know, they're only getting $200 an hour for their time. We're getting $300 to $350 for partner time. How are we going to get past that? So that's when I reminded that potential buyer. I said, let me ask you a question. In your firm, not who's going to hold the client's hands, I assume that's going to be a partner, who's going to do the work? He was curious to my question. I said, you see, in the seller, they have no seniors, managers, juniors, etc. So in your firm, who would do the work? He goes, well, based on the work we've seen in due diligence, almost everything they do would be senior level work in our firm. I said, what are your seniors getting billed out at? He said, $150 an hour. I said, I guess they're getting 2 now. You see, he was, again, looking at a piece of paper saying that's their billing rate. But what's your billing rate going to be? Are you going to be able to leverage it down? Is your quality control process so much more robust that you need 2 pair of eyes to review everything and they only had 1, in which case your billing rate would drop like a rock? So once again, just like profitability, it's not the seller's profitability, it's not the seller's billing rates, it's what are yours going to be. Maybe your technology is more efficient, maybe you have more layers of staff to leverage it to. Part of profitability is the tax ramifications. Deals structured with goodwill transactions, if everything else is the same, get paid less than the same deal that would get structured as, let's say, a consulting agreement. The 4th variable is the duration of the payout period. I will tell you from my smaller firm deals, most of those are 4 to 7 years, with most of them being 5 to 6 years. My larger deals are usually 8 to 10, sometimes even longer, with typically a 10-year payout. So that's kind of what you'll see as the average. So of the 5 variables, the first one is cash up front, if any. The second one is the duration of the retention period that adjusts the purchase price based on client retention. The third one is the profitability of the deal for the successor firm. The 4th one is the duration of the payout period on the balance due. And the 5th one is the multiple, because the multiple is the effect. Everything else was the cause. Let's take a simple example. Let's say all of you were large enough to acquire my $500,000 practice. And I said to you, pay me 15% of collections for 10 years with no cash down, structured as a consulting agreement. Would you do that deal? Me personally, I probably would. Heck, if I raised the fees 7.5% in years 1 and 2, I basically paid for the whole acquisition. If I lose a client after 5 years, I collected 500% and only paid 0.75. Had no money up front, no risk, all good. Yet that's 1.5 times. Perhaps an exaggeration, but one worth looking at. Now, some of you might say, but Joel, you're not figuring in present value, 10-year payout. You're right, I'm not thinking of present value. The reason I'm not is because I'm ignoring it. See, present value doesn't apply. It doesn't apply for 2 reasons. One, I've always been horrible at present value. I mean, I get it, but I don't know why I always struggle with it. But that's not a justification, I realize. But present value is based on an interest factor. If I'm paying you 15% of collections for 10 years, and it includes fee increases and those fees go up, I'm paying you that increase. That's better than any interest factor, so interest doesn't apply. It's cash flow and profitability. Now that same firm says, I want to be paid out in 5 years. Whatever you do in the second year locks the purchase price. I want 10% up front, but I'll still give you a current deduction. Now, depending on where you are in the country, you're looking at probably between 0.75 and 1.25. Now the same seller says, I want to get paid off in 3 years. Whatever you do in the first year locks the purchase price, and I want goodwill. There's nowhere in this country I can get them close to 1 time. If that same seller said, I want all cash at closing, I couldn't get them 50 cents on the dollar. So how do you start with multiple? Here, I wouldn't touch the deal at 0.5, and I'd run to the altar at 1.5. Multiple is the effect. The less money up front, the longer the retention period, the longer the payout period, the better the profitability of the deal structure, the higher the valuation, and the opposite exists. So one of the big mistakes people make when they negotiate these deals is they negotiate one variable at a time. How can you negotiate the multiple till you've negotiated all these other things? When I make an offer to a firm, it includes everything. This way, if they say, hey, Joel, I don't want to be paid off over 7 years, but I'll go 5, my answer is, well, Jane, then I can't give you the same multiple, because if I pay it over a shorter period of time, it impacts my cash flow. And it enables me to negotiate a deal more fairly by laying out the entire playing field and understanding, like the scales of justice, if you take something off of side A, it's got to affect side B. Now, I've had people say to me, Joel, it's funny how you don't talk about the difference in value between a tax client and a business client, because most people perceive, and I get why, that a business client is worth more money. Well, I did a session very recently for the AICPA. This exact question came up, and I asked everybody in the room on a pure realization, what do you make more money, doing the tax return or the business? And almost everybody said tax return. I said, on an exposure basis, where do you have more exposure, on the tax return or the business client? They said, oh, more exposure on the business client. I said, on a collection basis, what do you collect better, your tax clients or your business clients? They said, oh, tax work. So then I asked, why do you want to place a lower value? And I heard two reasons. One was it comes at a terrible time of year. My answer was, you chose to be a CPA, get past it, never want to hear that again. The second reason was a lucid one, that we have a higher turnover ratio on 1040 clients than on business clients. Very true for most firms. That's a retention issue. So if I'm paying someone 20% of collections for 5 years, or 25% for 5, or 17 for 6, whatever it is, well, then I don't have to lower the valuation for 1040 clients because I'm only paying if they stay. But if you have a lot of annual clients and you want a short retention period, it's going to hammer the valuation. One visit doesn't make constitute loyalty. 2 is a great sign. 3 makes me a lot more comfortable. So all these things impact the valuation, not because of the nature of the work necessarily, but because of the retention period. Now, larger firm deals work differently. First of all, if we go back to the deal structures, let's look at a couple of them and how they impact a larger firm deal. See, if I've got an $8 million firm merging up, most likely I have 1 or 2 partners looking at a fairly near-term succession plan. Maybe a couple others that are 2 to 5 years out, and the rest that are young. They don't want to retire, but they don't have the capacity to replace the retiring partners. What we've been able to do by understanding all those deal structures we walked through right before valuation is take those deal structures and apply them to each partner and customize it. So if partner A wanted an immediate sale, that's what they got. If partners B and C wanted to work 2 to 5 years, they got a 2-stage deal. If partners D, E, and F were 40 years old, they exchanged equity in their firm for the successor firm. What this understanding these different deal structures enables you to do in the larger firm world is customize a deal for each partner so that everybody doesn't have to have the same horizon and same sunset when doing a deal with someone else. There are typically a larger firm, like I said earlier, gets a lower multiple, a longer payout period. A lot of times there's, sometimes you see some of these big cash up front, but most of the time you don't. Most of the time you don't even see the seller getting the use of their AR and WIP because usually we'll need that money to fund operations and have a payback period on them. Where there's other differences, most small firms, there's no valuation placed for furniture, fixtures, and equipment. Large firms will put some sort of book value on it. Other things that can really hurt the value of a practice are things like leases. I got a call from a firm in Texas a little while ago doing $2.5 million, telling me how there were 3 partners. 1 was young, 2 were older. They wanted to merge with a firm that would help them with succession for 2 and growth for the 3rd. And then they went on to say that they just signed a 10-year lease with well-appointed space and great parking and got a ridiculously great value out of it. I asked them, well, you're $2.5 million. How big do you think your successor firm should be? And they said, probably 6 to 20 million. I said, don't you think they have an office? You see, by signing that lease, what that person just did was eliminated 80% of the firms that might have been interested. And the 20% of the firms that will be interested, most of them are going to reduce the offer they make to the seller by carrying that extra lease. Be very careful what you commit to if you're closing in on a succession plan. So leases could damage your value. What could increase it is having good staff. There are large firms that do deals purely for the basis of hoping to get some diamonds in the rough. Young talent, great value. When doing a deal, one of the things we talked about was a retention period. One of the things you need to focus on are the sellers participating in the fee increases from prior services, from new services. That's going to be part of your negotiations. Right? What very rarely does the seller ever get is if a client refers a client, that usually is the benefit of the successor firm. But we do give every seller a new business incentive program where if they develop new business and refer it, we make it worth their time. When selling internally, one of the things you have to understand is when partners buy out partners, they almost always buy them out at a lower value than market value. You don't usually charge a partner the same thing you charge a stranger. If Gretchen, Nikki, and I became partners 10 years ago and we're doing $2 million more than we were then, aren't they part of the reason? It's where sweat equity comes into play. What bothers me and scares me is how many firms don't have a retention period when they're buying out partners. If we have a clear notification process where you have to give me at least 2 years notification, if not more, and during those 2 years transition those clients in a very structured manner so that by the time you leave, the transition's been done, I could probably live with a lot of these no retention period deals. What concerns me is many practices have silos with partner loyal clients that don't do a proper transition. They leave and there's an attrition of the client base and they're still getting paid as if those clients were there. Part of your valuing of a partner equity should include a requirement for doing a proper transition, and if they don't, the penalty should be adding a retention period. And as unfair as it sounds, nobody gives you 2 years, 3 years notice before they get hit by the bus. But what I am concerned about is if we don't have a proper transition and clients are lost and the firm's still paying the same value, is the firm going to survive? You saw in 2009 and 10 some large firms that took some big hits in clients and their debt service to partners became a much higher percentage of their revenue. See, a partnership agreement, we teach a lot of classes about them. A lot of people think they're there to protect the partners. I don't. I think they're there to protect the firm. But one of the big things when valuing an internal sale is it's based on the following simple thing. There's 400 of you on the phone today. I bet you there's been thousands of people you've all consulted and helped them to decide to buy a business. How many of them did you say to your clients, hey, I just did the due diligence, I looked at the terms, if you do this deal, you're going to lose money, maybe break even for 5 years, it's a great deal, do it. None of you. So then you shouldn't be telling that to your partners. So a critical factor when valuing an internal succession plan is to make sure it's cash flow positive for the remaining partners. Now, smaller firms tend to do a multiple times your equity interest. Statistics show that most of those are between 0.5 and 1 time. Larger firms tend to do it on a multiple of compensation, where they'll look at maybe your last 5 years' income, average it out, multiply it by usually between 2 and 3 times, pay it out over 10 years plus capital on a K1. Obviously, I'm going through it quicker because there's a smaller percentage of us in this category. So you have a lot of options, equity options, compensation options. What I want to focus on is giving you a litmus test to make sure your deal works, based on the premise that the remaining partner should make more. So whenever someone quotes their buyout, I apply the litmus test. Let's say I'm a partner in a firm and all in I'm making, I don't know, 300 grand. And let's say we agree it's going to cost $125,000 to replace my labor. Well, that leaves $175,000 in the firm. How much of that should I get? How much of that should you get? And for how long? Because based on that simple thought process, I'm getting paid for my years of sweat equity and you're making more money. But if it fails the litmus test, what incentive does my younger partners have to buy me out? So it's very important, whether you're doing a multiple of comp or a multiple of equity, to make sure that your deal passes this litmus test. Be careful that too many partners aren't leaving at the same time, because it's not a financial issue if it passes the litmus test. It's how many people can we replace at once. Be wary of partners. I met with a partner recently who's cut his time down to 60% of full-time, but not his income or control. Hurts a lot of people. Be careful about replacing the role, not just the body. Sometimes I have someone say the audit partner is going to retire, but we have this great young woman in the tax department we couldn't wait to promote. Well, how does that make sense? We're replacing the audit partner with a tax partner? Right? Got to make sure we have the capacity to replace these people. You know, if I've got 3 partners leaving, again, the money might make sense, but do we have the expertise and the capacity to do them? And all of these things need to be figured into your ownership agreement. But with our last minute, let's look at the last takeaways for this class. And I apologize if I had to go through a lot of it quickly. This is usually a 2 CPE class that I did in 1 CPE. So if I sounded like a 33 record on 78, you'll know why. And by the way, if you don't know what that means, you don't have to worry about succession. But here's your takeaway. It's the 4 C's that I operate by. The first one is chemistry. If you don't want to eat lunch with someone, don't do a deal with them. Your clients are loyal to you because of you. If you're not comfortable with your successor, why would your clients and staff be? Make sure that if the seller is going to have to make wholesale changes to the client base and the way they're serviced, you're not going to have continuity. That's a deal not to be done. Your clients like the way your ship is sailing. They have to be able to keep it sailing in a similar direction. Firms have cultures on how they build people, how they treat their staff. Even IT as an example. Do the cultures make sense? And the fourth C is capacity. If we're a 5-partner firm and 2 of us want to slow down, do you have the capacity to replace 2 working full-time partners? So chemistry, continuity, culture, and capacity. Remember, a good deal is a fair deal. The buyer should make more money, but the seller needs to get a reward. And don't negotiate one variable at a time. It's a package. So if you want to increase the value of your firm, make sure you're focusing on your metrics. Update your IT. Avoid going into long-term leases that someone be stuck to. And if you've got good talent, maybe they're not ready to be your successor, but good talent, flaunt it. So this is how you get your 1 CPE. Nikki's going to give you the last polling question to make sure that you get your CPE. And if there's any questions, we'll take them as well now, Nikki.
Okay, we've got the final question here on the screen. Go ahead and take a moment here to answer. Over the next 5 years, what percentage of your partners will be reducing their time commitment to the partnership? Joel, we did have several questions. Do you think that it would be best to include them in the follow-up email?
I'll tell you what.
Since we've reached our time limit?
Yeah, I'm happy to do it, but I feel for the people that are there. So why don't you have those questions emailed directly to me? Mm-hmm. And over the next 24 hours, I will respond in writing to every one of those questions. Is that possible, Nikki? Do we have the technology for that?
Absolutely. Yes,
Okay.
we sure do. So anyone who did have a question that we didn't have time to answer, Joel will respond individually. If you registered through Transition Advisors, look for an email from me later today that will have the link to the online survey that you need to do. For those of you who registered through CPA Academy, I believe you all know how to handle that process, or you can follow up with them directly with any questions. And if you have questions at all, feel free to contact me by replying to any of the reminder emails, or you can contact Joel. His information should be on the screen.
I feel terrible. My run-on mouth prevented those questions from getting answered, but I promise you all you will get a personal response from me.
Okay. Well, great. Thanks so much, Joel. Thanks, everyone, for joining us today. We appreciate it, and we hope you'll join us for another webinar.
Have a great day, everyone.